If you're looking to purchase a home or maybe refinance an existing mortgage, probably one of the first things that we're all going to do is take it to the internet. Now, there's so much information on the internet, it's pretty chaotic and even can be confusing at times. Luckily, there are two types of loans that are regularly used or are used the most, and that's going to be an FHA loan and a conventional loan. And if you stick around to the end of this video, I'm going to let you know which loan is better and which one to choose. So let's get started with your FHA loan. If you select an FHA loan, you can expect to see a minimum down payment of 3.5%. The way you calculate that, it's a simple math. Just take your purchase price times 3.5%, and that's the amount that you would need to secure this type of loan in down payment. What's also going to be included in an FHA loan is going to be what they call upfront mortgage insurance. Now, this upfront mortgage insurance is typically financed into the loan, and that amount is 1.75% of your purchase price. Another component that's going to be included in an FHA loan is going to be your monthly mortgage insurance. Now, this monthly mortgage insurance is going to be 0.85%. That's going to be added to your monthly payment. And so a couple of good things about this monthly mortgage insurance on an FHA loan, it's the same, it's actually the same across the board. And what I mean by that is if you have a lower credit score on the lower end of 600 or a higher credit score, 700 plus, you're going to have that same amount in monthly mortgage insurance. So that's a good thing. But a possible drawback to that monthly mortgage insurance on an FHA loan is actually that it is there for the life of the loan. What I mean, and what that means is it's there for life. It'll never come off there until you actually refinance that loan into a conventional loan. You have to have, in order to do that and get rid of the mortgage insurance, there's several ways to do it, but one of the more streamlined ways to do it is refinance it and hope that you have 20% of equity in that house to be able to remove that mortgage insurance. So once again, the FHA loan is not, you can say that it's not really credit score based, it's credit qualifying. As long as you have a qualifying score on an FHA loan, you should qualify for some of the better rates, just like in a perfect credit score, excellent credit score, I should say, of 740 plus. Now, so once again, let's go over the drawbacks or the possible drawbacks. You're going to have an extra charge of the upfront mortgage insurance. That's 1.75%. Also, a drawback, one of the possible drawbacks is going to be that monthly mortgage insurance that's going to be there for the life of the loan. So it doesn't matter if you're there 10 years or 20 years, you're going to keep paying that mortgage insurance. So we'll go the differences and explain why it's going to be different on a conventional loan. So some of those are two. Probably some of the two things that you'd probably want to consider if you're going to go with an FHA loan. But also, it might be a great thing for you if you have a lower credit score and lower down payment, because that monthly mortgage insurance and the minimum down payment required is going to be a positive for you. So let's compare your conventional loan and see what the differences are here. Here, a conventional loan, there's also a minimum requirement of 3% down. Some folks, some buyers out there don't know that. So 3% down can be your minimum down payment that would be acceptable on a conventional loan. You'd also 3 to 5%, I should say. So whether it's 3%, there's a program there for you, or it's 5%, it's usually the typical on a conventional loan. But there's also mortgage insurance. And mortgage insurance, just to let everybody know, it doesn't benefit the buyer at all. Just because it's called insurance, it doesn't help you. This is actually, I guess, a safeguard for the mortgage company in case you actually default or go into foreclosure and don't make your payments. That money is still owed. So they have this mortgage insurance to protect the mortgage company, so they can get some of that money back, collect the investment, which is the home, and try to sell it on the market, try to get all that money back. So it's actually on every loan that has less than a down payment of 20%. Because it's a higher risk, they're going to carry this mortgage insurance on this property. And there are some good ways to get rid of that mortgage insurance without having to put that 10% to 20% down. And that's where a more detailed discussion would be to give myself a call and my team, and we can help you walk you through that to save you some money. So also the FHA, the conventional loan, I should say, compared to the FHA on the mortgage insurance, it actually can be removed after a certain period of time. Once you have 20% of equity in that home, it'll actually be removed automatically, or you can have it requested by your bank, and you have to contact your bank on that to have that removed. So it is removable, and if you plan on staying in your home more than 7 to 10 years, this might be a better loan for you, because if you do the FHA loan, no matter how long you stay in that house, you got to remember you're going to be putting extra money that doesn't benefit you in any way, and paying this monthly mortgage insurance for the life of the loan, or as long as you actually live in that property. So the other thing here on the mortgage insurance on conventional loan, that's actually credit score based. So you have to have good credit. And not I want to say good credit, you have to have, it's based on, if you have a lower credit score, then your mortgage insurance is going to be high. Be super high because you have lower down payment, right? So if you have a higher down payment and a higher credit score, definitely the conventional loan might be the better route for you to go, because it's, your higher down payment, you have better interest rate, and you're going to have lower mortgage insurance. So FHA loan, the mortgage insurance is not really credit score based, it's qualifying based, and it's the same mortgage insurance through and no matter what score you have, it's a lower score or a higher score. And then the MI, or the mortgage insurance on a conventional loan, is going to be credit score based as well as down payment based. So higher credit scores, higher down payment, definitely want to go with a conventional loan. And to answer the question, which loan is best? Is it an FHA loan or is it a conventional loan? And if you guys have followed my other videos, you guys would know the answer is going to be it depends. It really depends on what's best for your particular scenario. Not one loan is the same, and not one buyer is the same. So just because you see an interest rate that's a low interest rate, that doesn't mean that that's the best loan for you. What the best loan for you is that it depends on your particular scenario. Don't compare yourself to a friend, or don't compare your scenario with what you see on the internet. You gotta definitely see, what's particular to you, what you're looking to do, if you're gonna, live in the house for 5 to 7 years, or 7 to 10, or if you're going to stay in that house until, until the 30 years is up. So if you plan on doing that, then, you really got to restructure the way you're going to look at your finances and try to pay down this house, or pay as little toward the house because you're going to be leaving it anyway. I hope I've answered your questions. If you have some other questions about this particular video, or would like to contribute and have us answer your particular question, shoot us a comment and hit the subscribe button. Don't forget to hit that bell. Until next time, remember that answer is always, it depends on what's best for your particular scenario.
Thank you.